private or public? This choice can significantly impact a company's future. Today, we're exploring the key differences between private and public companies, shedding light on how these structures shape businesses. At its core, the distinction lies in ownership. Private companies are owned by a limited number of shareholders, often founders, investors, or management. Their stocks aren't traded publicly. Public companies, on the other hand, sell shares to the general public through stock exchanges. This difference in ownership leads to varying regulatory requirements. Public companies face stricter regulations, including mandatory disclosures to the Securities and Exchange Commission. They must provide detailed financial reports and adhere to specific governance standards. Private companies operate with fewer reporting obligations, allowing them to maintain a higher level of privacy. When it comes to funding, public companies have a distinct advantage. They can raise capital through stock markets, tapping into a vast pool of potential investors. Private companies, however, rely on private investments, venture capital, or reinvesting their own profits for growth. Control and flexibility also differ between these structures. Private companies maintain more control over their operations and decision-making processes. They can focus on long-term strategies without the pressure of quarterly earnings reports. Public companies must consider shareholder interests and regulatory compliance in their decision-making, which can sometimes limit flexibility. Interestingly, many large and successful companies choose to remain private. Examples include Koch Industries, Mars, Bloomberg, and Cargill. These companies demonstrate that private ownership doesn't necessarily limit growth or success. Both structures have their advantages and disadvantages. Private companies benefit from increased privacy, greater control, and lower regulatory costs. However, they face challenges in accessing capital and determining their market value. Public companies enjoy easier access to capital and enhanced visibility, but must navigate complex regulations and public scrutiny. When choosing between private and public structures, businesses must consider their long-term goals, growth plans, and desired level of control. Companies prioritizing rapid scaling and extensive funding might lean towards going public. Those valuing privacy and autonomy might prefer to stay private. Understanding these differences is crucial for business owners, investors, and anyone interested in the corporate world. The choice between private and public structures can shape a company's trajectory, influencing its operations, growth potential, and overall success in the marketplace.